Wells Fargo made $20 billion in profit last year. Your savings account paid you 0.01% interest. That's not a typo, 0.01%. Meanwhile, they're lending that same money out at 7%, 18%, even 29%. That's just one of 10 systems banks use to make money off you every single day. By the end of this video, you'll see exactly how all 10 work. Interchange fees, card swipe profit. Every time you buy anything with your debit or credit card, the bank makes money, whether you pay your card off in full or never touch a penny of interest. Here's how it works. Whenever you tap, swipe, or insert your card, the bank takes a cut of the transaction, usually 1 to 3%. You never see it. It doesn't show up on your statement, but the merchant pays it, and they quietly raise prices so everyone covers the cost. Last year, banks made over $140 billion from swipe fees alone. It's one of the most consistent, guaranteed income streams in the entire financial industry. And it doesn't matter whether you use debit or credit, the bank collects either way. For you, this is why some stores push cash only or charge extra for card use. They're not being difficult. They're trying not to bleed margins to the banks. Overdraft fees and the NSF penalty loop. Overdraft fees are supposed to be a punishment. In reality, they're one of the most profitable products banks have ever created. If your account drops even $1 below zero, the bank hits you with a $27 fee. But here's the part they never advertise. Banks process your largest transactions first, not in the order you made them. They do this because it triggers the maximum number of overdraft events. Example, you have $60 in your account. You buy lunch for $12, gas for $35, and later a $55 charge hits. If processed in order, 1 overdraft. If processed biggest to smallest, 3 overdrafts. That's $81 in fees for running out of money once. Banks made about $6 billion on overdraft fees last year, and the people who can least afford them end up paying the most. For you, this system isn't an accident. It's engineered to turn one mistake into a revenue engine. Monthly maintenance fees, paying to access your own money. This one sounds insane when you really think about it. Banks charge you a maintenance fee just to hold your money. You're literally paying them for the privilege of letting them use your cash to make more money. Most maintenance fees run $5 to $15 a month, small enough that people ignore them, big enough that banks made billions from them last year, and they're structured to target the people least able to avoid them. The trick? The requirements to waive the fee are written so most people miss them, like needing direct deposit, a minimum balance, or a certain number of debit card transactions every month. One slip, one late paycheck, one forgotten transfer, and the bank quietly scoops another $12 from your account. For you, if a bank charges you to store your money, they're not doing you a favor. They're treating you like a subscription customer. ACH and wire fees, charging you to move numbers. Moving money from one bank to another is digital. It's instant. It costs banks basically nothing. But they still charge you $15 to $30 for an ACH transfer, and up to $45 for a wire. Here's the wild part. Banks pay almost nothing to use the payment networks. ACH processing costs fractions of a penny. Wires cost maybe $1. Everything above that is pure markup. And they double dip. Incoming wire? Fee. Outgoing wire? Another fee. Need it fast? Expedited. Fee. International? That's a whole new menu of charges. This is why banks still drag their feet on free instant transfers. Slow payments make them more money. For you, when your bank charges $30 to move your own money, they're not covering their costs. They're taxing convenience. Minimum balance traps your money held hostage. Banks love advertising free checking until you read the fine print. Most free accounts require you to keep a minimum balance, sometimes $500, sometimes $1,500, sometimes more. Drop below that even once, and the bank hits you with a $10 to $20 penalty. Here's the trap. They set the minimums higher than what most people can comfortably maintain, especially when rent, bills, and automatic subscriptions hit at different times of the month. So banks are effectively holding your own money hostage, forcing you to keep a certain amount locked up, doing nothing, just to avoid being penalized. Meanwhile, they're lending your minimum balance out at 7%, 15%, even 29%, while giving you nothing in return. For you, minimum balance rules aren't about account health. They're engineered breakpoints designed to trigger predictable fee revenue. Lending spread. How fractional reserve really makes banks rich. Most people think banks lend out the money you deposit. Not even close. Banks lend out your money multiple times over. It's called fractional reserve banking. Here's the loop. You deposit $1,000. The bank keeps a tiny fraction on hand, then lends the rest out. The borrower spends it, and that money gets redeposited into the banking system. Then the cycle repeats, again and again and again. That original $1,000 can turn into $8,000 to $10,000 worth of loans, and every one of those loans earns interest. So banks are effectively multiplying your money like a printing press and pocketing the spread. For you, this is why banks desperately want your deposits. Your dollars aren't sitting in a vault. They're being multiplied into assets that pay the bank over and over. Credit card interest, the 20% trap most people never escape. Credit cards are the most profitable product banks have ever invented. Not because of fees, not because of rewards, because of interest. The average credit card APR today is 20 to 28%. Some store cards crack 30%. And once a balance starts rolling month to month, the bank turns into a silent business partner in your life. A $1,000 balance paid at the minimum can take 8 to 10 years to pay off, and you'll often pay more in interest than the original purchase. Even people who pay on time still fuel the system. Banks use interchange fees and rewards programs to push more spending, because more spending leads to more revolving balances. For you, paying your card in full isn't winning the game. It just means you avoided the trap. Most people don't. ATM double dip, paying twice for your own cash. You think you're paying $3 to grab cash? Not even close. Banks make money twice, once from the ATM owner and once from your bank. Here's the breakdown. The ATM owner charges $3 to $5. Your bank charges another $2 to $5 for using a non-network machine. Add them together, and you can pay up to $12 just to access your own money. And it gets worse. Banks get kickbacks from ATM networks for routing your withdrawal through their system. You think it's random. It's not. It's optimized. For you, this is why airports, casinos, concert venues, and stadiums have the highest ATM fees. They know you're trapped. Payment order optimization, the algorithm designed to drain you. Banks love to talk about processing payments as they come in. That's not what actually happens. Behind the scenes, banks reorder your transactions to maximize fees, minimize your balance, and increase the odds you dip below zero. It works like this. Instead of processing charges chronologically, they process largest to smallest. Why? Because a big charge hitting first wipes out your balance. So the smaller charges that should have cleared now cause overdrafts. It's legal. It's deliberate. And regulators have fined banks hundreds of millions for abusing it. Yet most still do a softer version today because the revenue is too good to give up. For you, when your account mysteriously goes negative, it's not bad luck. Someone engineered the math to make sure it happens. The float. Banks profit while your money is in transit. Here's one of the sneakiest profit engines in banking. The time between when you send money and when it actually arrives. That delay, the float, is free money for the bank. When you initiate a payment, banks don't always move the money instantly. They hold it for hours or even days, especially with ACH transfers. Meanwhile, at scale, they're earning interest or investing that in-motion cash. Multiply those delays across millions of transactions, and banks make billions simply by slowing things down. It's why they fought instant payments for years. Fast money means less free profit. For you, if a transfer ever feels slower than it should be, it's not a tech problem. It's a business model. Banks don't just make money from lending or interest. They profit off movement, mistakes, delays, and design. None of these systems are accidents. They're engineered, optimized, and refined to extract a little bit from you every single day. Now that you know how all 10 work, you'll never look at your bank the same way again.